Hey Degens, welcome back to Degens Journal, your no BS source for everything shaking the crypto world. Today's episode is packed with regulatory shifts, massive hacks, big-time Bitcoin buys, and strategic moves shaking up the blockchain industry. Today's headlines: the SEC opens public comments on XRP and Solana ETFs. Nobitex hacked. Over $81 million in crypto drained. Europe's first Bitcoin treasury company just added $20 million in BTC, now holding over $170 million. Chinese ASIC giants move production to the US under tariff pressure. USDC approved as collateral for regulated futures trading. Story 1. SEC opens comments on XRP and SOL ETFs. The US Securities and Exchange Commission, SEC, has officially opened a public comment period for two new crypto ETFs proposed by Franklin Templeton, one tied to XRP and the other to Solana, SOL. These ETFs aim to be listed on the Cboe BZX exchange, the same exchange that handled some of the spot Bitcoin ETF filings earlier this year. While the SEC hasn't given a green light yet, starting the comment process is a critical milestone. It shows these filings are being taken seriously and that we might be closer than ever to a spot XRP or Solana ETF. Now, here's why this matters. A spot ETF would allow mainstream investors to get direct price exposure to these assets through traditional brokerage accounts without needing a wallet or exchange. That's huge for adoption. But don't pop the champagne just yet. The SEC made it clear that this step doesn't imply any approval. In fact, they're actively asking for public feedback, a move that often precedes delays or legal wrangling. Still, the timing is curious. With recent approvals of Ethereum ETFs, the door seems slightly more open than it was a year ago. And let's not forget, XRP already won a partial legal victory against the SEC in 2023. If anything, that gives this filing a unique advantage. The big question now is, will the SEC finally budge? What do you think? Are we heading into a multi-chain ETF era, or is this just more smoke with no fire? Let us know in the comments. Story 2. Nobitex hacked for $81 M+. In one of the biggest crypto hacks of the year so far, Iranian exchange Nobitex was compromised for over $81.7 million in digital assets. The breach targeted wallets across Tron and various EVM-compatible blockchains, using a clever but dangerous trick, a vanity address exploit. For those unfamiliar, vanity addresses are customized wallet addresses that look legit or meaningful, but in this case, they were crafted by the hackers to infiltrate protocol operations and trigger suspicious outflows. The attack was first flagged by on-chain investigator ZachXBT, who continues to expose major exploits across the crypto space. He tracked the movement of the stolen funds, confirming multiple transactions leaving Nobitex-linked wallets in real time. Nobitex later confirmed the breach, stating that a portion of its hot wallets had been accessed without authorization. They moved fast, suspending all operations tied to those wallets and issuing an emergency statement to calm their user base. Here's the silver lining. According to Nobitex, cold wallet assets remain fully secure, and they've committed to covering all damages using their insurance fund and internal resources. So while it's a major hit, users are, in theory, protected. But this incident is a sharp reminder. Even large regional exchanges are vulnerable, and hot wallets, no matter how monitored, will always carry risk in crypto infrastructure. Story 3. Euro Bitcoin giant buys $20 million. More big moves are happening across the Atlantic. The Blockchain Group, a Paris-listed tech firm, just added 182 more BTC to its reserves, a purchase worth nearly $20 million. This latest buy brings their total holdings to 1,653 BTC, currently valued at over $170 million, making them the first true Bitcoin treasury company in Europe. In other words, they're pulling a micro-strategy, but with a French accent. And here's what's interesting. This acquisition wasn't a one-off. It was funded through a recent wave of convertible bond issuances, which means institutional backers are in on the strategy. Some of the notable investors include UTXO Management, Moonlight Capital, Tobam, and Swiss Bank Europe, all of whom bought into the company's long-term Bitcoin thesis. The purchase was executed by Banque de Lubac and CA, a French commercial bank, and Swiss, a regulated digital investing platform. For custody, they partnered with Taurus, a Swiss digital asset infrastructure provider, to ensure secure storage. This move is part of a broader trend we've been watching. While US-based firms dominate headlines, European institutions are quietly stacking BTC, reinforcing Bitcoin's position as a preferred treasury asset on both sides of the Atlantic. It also signals something deeper. Bitcoin is no longer just a hedge or speculative asset. For many forward-thinking companies, it's becoming a strategic reserve, just like cash or gold once were. Story 4. ASIC makers shift to the US. Something big is happening behind the scenes in crypto infrastructure, and it's all about mining hardware. The top 3 producers of Bitcoin ASIC miners, Bitmain, MicroBT, and Canaan, are now moving their manufacturing operations to the United States. Why this sudden shift? Tariffs. Lots of them. The US has been imposing heavy import duties on Chinese tech products since the Trump administration, with current tariffs sitting at around 25%. At one point, they even exceeded 100%. Instead of absorbing those costs or risking supply chain delays, these giants are adapting fast. By setting up local production in the US, they're not only avoiding tariffs, but also getting closer to key mining clients, especially after the 2024 halving, which increased the demand for more efficient hardware. Let's look at the scale of this shift. According to the University of Cambridge, Bitmain currently produces 82% of all Bitcoin ASICs globally. MicroBT holds 15%, and Canaan about 2%. That's 99% of the global ASIC market in the hands of just 3 companies, all of them now pivoting toward US soil. This isn't just a strategic play, it could reshape the entire mining supply chain. By localizing production, it reduces dependence on Chinese logistics, cuts down on shipping times, and potentially boosts domestic mining capacity in North America. It also sends a signal. As regulatory pressure and energy debates grow louder, ASIC production is becoming geopolitical, and the US wants a bigger seat at that table. Story 5. USDC approved as futures collateral, almost. Now this is a big step for stablecoins, and for the future of regulated crypto finance in the US. Coinbase Derivatives, in partnership with Nodal Clear, just announced that USDC Circle's US dollar-backed stablecoin will soon be accepted as collateral for margin futures trading. Let that sink in for a second. We're not talking about offshore or unregulated platforms. This is regulated US derivatives infrastructure, and now they're opening the door to a stablecoin as a primary collateral asset. Here's what we know so far. This would be one of the first fully regulated use cases of a stablecoin, like USDC, in the US futures market. The process is pending final approval from the Commodity Futures Trading Commission, CFTC, but all indications point to green lights ahead. Coinbase Custody Trust will act as the official custodian, ensuring the stability, transparency, and regulatory compliance of the entire setup. Why does this matter? Because for years, stablecoins were seen as tools mostly for crypto-native platforms. They were fast, cheap to move, and reliable but not part of the traditional finance toolkit. This move starts to blur that line. If USDC becomes a recognized collateral asset in regulated US futures trading, it will open the doors for institutional traders to engage in crypto markets without converting back to fiat, enhance liquidity and capital efficiency across both TradFi and DeFi platforms, signal growing trust in tokenized dollars as part of the broader financial system. It also places Coinbase at the center of the infrastructure, not just as a trading venue, but as a custodian, clearinghouse partner, and onboarding ramp between traditional and decentralized finance. This development has the potential to change how margin is managed, how capital is deployed, and ultimately, how both retail and institutional players interact with the crypto derivatives market. In short, stablecoins just got real, and TradFi is taking notice. That's it for today's Degens Journal. Which story caught your eye? Let us know in the comments, especially what you think about the potential XRP and SOL ETFs. And hey, if you want to stay ahead in crypto and never miss a major move. Like, subscribe, and tap the bell so you're always first. Catch you in the next one, Degens. Stay sharp, stay Degen.